Hello and welcome to today's Premier Account Market Update for March 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have 17 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities as we roll through the ASX top 50 stocks with a summary of the FY 16 earnings. We conclude with a technical trend portfolio allocation and a short-term market outlook. The Investor Signals Premium Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow, capital growth, all in a strict investment mandate, and importantly, the assets remain in your name. If you'd like to know more about the service, please contact me, Leon at investorsignals.com. Moving straight into a graph of the index of the top 50. On screen is the XFL. So the basic pattern that we've been looking at in the market is we've had this bearish structure of lower lows and lower highs, and that's really been met with a lot of commentary in the market about slower global growth, recession fears, banking issues in Europe, problems in China, potential slowdown in the US, and that's all fed into, heightened sensitivity in the market around earnings outlook. And what we're now seeing is a counter trend bounce within sort of this downtrend. What's a little unknown is, how high does this counter trend take us? As a minimum, it appears that the Australian market's heading up to around 5,500, and that's largely a result of correction that's underway in the resources and the banking stocks. So as we roll through the top 50, let's have a quick look at the patterns within the top 50 companies and identify which ones we're holding in client portfolios and what type of derivative strategy we're using. AGL, just on over a 4% dividend yield. I think the good news is priced in here. The company's seen good earnings growth. It's increased its dividend payout ratio. I think there's a bit of earnings volatility over the next 12 to 18 months. We're a buyer of it back at 15.50. Asiano, not doing here at the moment, but looking forward to the breakup of Asiano post the Cube Brookfield deal, and we'll be interested in taking a look at Cube and how its business sits with the Asiano assets inside it. Amcor, 10% underlying earnings growth here, defensive contributor to client portfolios. You want to be owning it at these levels and selling tight covered calls, collecting 10% cash flow from the dividend and the call option. It's a defensive asset and should be in portfolios. AMP, we've seen the earnings fall from 10% down to around 5% as a outlook for growth over the next sort of 6 to 12 months. I think that creates sort of fair value around this 550. So whilst we're interested in AMP, we're cognizant that it's running into some resistance, but our preference is definitely in the 4 banks over AMP. So on that note, ANZ's been one that we've been adding exposure, and we see ANZ trading back up to around $27.50 before it consolidates another 10% higher, and that feeds into our view as to where we think the index potentially runs into resistance. APA, I think this is a defensive name for portfolios and is worth considering at these levels. ASX have 5 to 7% underlying earnings growth, 5% dividend yields, getting a little bit expensive on an outright basis, but if you believe that there's potential corporate action in the pipeline over the next 6 to 12 months where ASX may be acquired by another exchange, then there's upside. But otherwise, on a pure earnings basis, ASX looks reasonably full value and close to resistance. AZJ, we've seen it bounce after missing its earnings, excuse me, by almost 20% on the same time last year. At $4.20, the stock's fair value, and we're selling calls as a way of hedging any further downside risk in AZJ. BHP, I've been looking for this to rally back to around $21. I think it's still got a little bit further to go, but again, if we were to see the index trade at 5,500, I think BHP at 21 is achievable. Certainly the bounce in iron ore and petroleum prices is helping to keep this rally underway in BHP. Brambles, one of the standout results of earnings season, underlying earnings of around 10%. At around $12.50, the stock's pretty expensive, compressing down on less than a 3% dividend yield. We'd certainly be aggressive buyers of it back at around $11.75, so it's on the watch list over the coming weeks. CBA, as with all the banks, a recovery's underway. look, given that CBA trades on a higher price to book ratio than the other banks, I don't see CBA having the same upside potential. I think it runs into resistance at around $80, and then I look for the Australian banks to consolidate and move sideways, but still a little bit further to go there in CBA. Coca-Cola, so starting to win back support of the market. So we've had 2 earnings results now where the company's met market expectations and delivered about a 5% growth in underlying earnings, puts the stock on just over a 5% dividend yield, runs in a resistance at around 9.50. Don't see it doing any more than that. Happy to sell calls up at that level to drive the extra cash flow out of it. Computershare disappointed in earnings result with its earnings result, and I think it's going to be an ongoing issue for the company at around 10.50. Take the opportunity to sell covered calls over it. I think it tracks sideways at best, and that's roughly where the new range sits for Computershare. CSL, disappointed a little. The market was looking for double-digit earnings growth. It delivered high single-digit earnings growth with the Aussie dollar pushing up to 74 cents at the moment. You're seeing some of the buying interest in CSL abate, but I think somewhere around this $100 mark, the stock's good value, and it's an okay consideration for portfolio as a buy right. Keltec, so this is a name that we own, and we've sold tight covered calls over it. I think over the course of this year, it's really just going to trade sideways somewhere around this sort of $33 to $37 range, and it tracks sideways, delivering a good dividend. And combining that with the call option, generating around 10% cash flow out of it. Crown, when you look at what's happening to win casinos in America, its share price has rallied from around 65 back up to around $85. I think we're probably in the early stages of starting to see a little bit more positive momentum for Crown. Obviously, if James Packer looks to privatise it, we could see a takeover bid around $14.50, which will help underpin the share price, I think, from a downside risk perspective at the moment. The property stocks are under a little bit of pressure off the back of the better GDP data here in Australia and the less probability of an interest rate cut. So that's just feeding through to a little bit of selling pressure in some of the defensive names at the moment. So I'll just highlight that as we go through. We can see Goodman Group off the highs there a little, but these are good assets and probably an opportunity to look to buy them on the dip if this selling actually gains momentum as money rotates out of these defensive names into growth names, being banks and resources. GPT, so we're buyers of this again back down at around this $4.70, but that puts a stock on about a 5.5% dividend yield. IAG, disappointed with its earnings numbers and around 550's fair value. We're taking the opportunity there to sell covered calls and drive extra cash flow out of IAG. IPL just simply got overdone here on the downside. Fair value for it's back up at around $3.50. Look for the upcoming earnings result in April and the May dividend, but certainly that earnings result should support that the stock's worth around $3.40. We owned it at lower levels here. We're taking profit up the top prior to this sell-off, and it's just back on the radar again now. We've been mild buyers of it in the last few days of last week. James Hardie, I think this is one that's just interesting to keep an eye on the short side. I think it's starting to look a little expensive from a PE perspective, and looking at the forward earnings growth, I think at around $18.50 a stock should run into resistance and struggle. Lendlease, so we own this. This has been one of our preferred property plays, and I had mentioned on prior recordings when it was down at these lows that it was oversold and looking for a recovery back to around $14.50. Happy to look at selling covered calls up at around $14.50. I think that caps the upside short term. MPL, so this is one of the core holdings in portfolios. So we own this at lower levels. I'd mentioned that it delivered great earnings result. Interesting, even in light of the prospect of a further 5% increase in policy premiums, the stock's starting to look a little bit expensive up here, I think, at around $280. I think fair value's somewhere closer to around $260, $270 in Medibank Private. Macquarie, good counter trend bounce here at the moment. I think it's just worth keeping an eye at around sort of that $70 level, whether the stock runs into resistance. But again, our preference has been the major 4 banks over exposure to the investment bank. So NAB's one of those names that we're staying exposed to on the long side, looking for it to trade up to around $29.50. That'll compress the dividend yield in the Australian banks back down to around 5.5%, 6%, and I think that's around where they consolidate. Newcrest Mining, we've seen gold break out higher. Probably the catalyst to really start this was when the BOJ, the Bank of Japan, moved to negative interest rates following similar actions in the European or by the ECB, and we see gold start to break higher. Newcrest has rallied off the back of that, so we've got the beginning of a higher high. We haven't yet created the higher low structure, and over the coming months, if we see Newcrest pull back to around $15, we might be ready to take another look at that, thinking that the upward rally has further momentum. In Origin, at around, so with the bounce in oil prices, we're seeing a little bit of short covering occur in the energy names. You can see on screen there, I think somewhere between 550 and around 650 captures full value. That really equates to a spot oil price of around $55 a barrel. We're not there yet, so even where we sit at the moment factors in some further growth that hasn't yet materialized within the oil price. So I think that sort of gives you an idea of sort of where consolidation is likely to be in Origin. And I think at or near those levels, it's worth trying to sell calls to drive extra income out of it. Oil Search, so taking profit here at the moment in Oil Search. QBE, we've seen this bounce. So US 10-year interest rates compressed down to around 1.6. We're starting to see that move back up to 1.8, 1.9%. So higher interest rates in the US is good for QBE. Fair values back at around maybe, I thought sort of somewhere around $11. Looks like it has the capacity to maybe push up to around $12.50. And I think somewhere around there it's worth selling covered calls to drive the extra income on QBE. Ramsey did exactly as we thought. We were looking for a buy point here and it running into resistance. It's done that. I think this is really a consolidation pattern driven by the fact that the stock trades on a high PE, maybe delivers underlying earnings growth of around 15%. And I think in this environment, that means that the stock consolidates, but I don't see the market paying up a premium for 15% forward earnings growth at the moment when it's trading on around a 25 times PE. Rio, so we're seeing with iron ore prices recovering, we're seeing the commodities bounce. This ties into the thesis that maybe the index can trade back up at 5,500 points. In that environment, we'd see Rio back up at around $50 to $52. South 32, South 32 have low gearing levels, and it may very well be that we see this trade back up to around 160. A big part of this at the moment is that we're seeing the US dollar soften, which is helping a recovery in commodities. But there's a lot of short covering here, so it's not surprising that the rally is sharp. And we're probably somewhere around 10%, 15% away from it really running into resistance and either consolidating or have some mild pullback. But it's more than probable that we've seen the lows in the commodity market at the moment. So here's a good example of a market darling a week or 2 weeks ago, where the market was paying an ongoing premium for exposure to Scentre Group as defensive earnings. The yield was compressing down to almost 4% with about 3% earnings growth at best. So that's expensive for a property trust, and we're seeing it pull back. I think fair value's back closer to around $4, and it's not until it traded at those levels that we'd be looking to add it back into portfolios. Seek actually delivered an okay earnings result. So we start to keep this on the watch list. The stock's broken out, created a higher high, a higher low pattern. On a pullback to around 1430, we might be willing to take a look at Seek in the coming weeks. Stockland, so I've highlighted this as one of our preferred exposures within the property play, but we are running a fairly tight covered call on it. This company delivers about 6 to 7% underlying earnings growth. And roughly around about a 5.5–6% dividend yield. So I think the strategy here is it's okay to have exposure to Stocklands, but selling the covered call at around $4.10, collecting the upcoming June dividend, delivers a cash flow in excess of 10% out of Stocklands, and I think it really bounces sideways at around that sort of $4 level. Sonic Health, again, another name that we like, but we have been aggressive selling the covered calls over it, and that just fits with our view that there's some uncertainty around the Australian earnings for Sonic, and the range for the stock somewhere sort of between $17 and $19.50, and I think it's just a matter of sort of selling the covered calls, boosting that cash flow up to 10%, and sort of recognising that the stock's likely just to trade sideways over the most part of this year. So Santos, in line with the other energy names, we're seeing a recovery in Santos. Again, it's hard to sort of get a handle on where is true resistance in this move higher in oil, but one would think that we're probably, within, again, I think sort of 10% of sort of where a consolidation begins to occur. So could Santos trade back up to maybe, $4.50? Yes, I think it probably can. In the absence of some corporate action where there's a takeover offer for Santos, I don't see it doing any more than that, and it consolidates and moves sideways. Suncorp, so actually whilst the insurance margins were down a little, the banking division continues to perform well. I think Suncorp actually has the opportunity to trade back up to around $12.50, and at that level I'll be looking at selling covered calls over it. Stock trades on about a 6.5% dividend yield. Sydney Airports, I still think this is a sensible mix for portfolios. It's certainly more defensive. It's a matter of going out further, selling the 675 calls into the September period, collecting the upcoming June dividend, but the stock sort of trades sideways. It is expensive, but you're paying for a reasonably defensive yield there in Sydney Airports, and I don't see it providing too much volatility. Therefore, owning at these levels, selling the call option, collecting the dividend, you're generating about 10% cash flow and allowing for some capital growth through that strike price being a little bit higher than where it's trading at the moment. Transurban, so again, if you go back a week or so, this was a darling of the market. We're starting to see a little bit of heat come out of it at the moment. That just feeds into that view with bond prices ticking back up, or the yield on bonds ticking up. We're starting to see some of these safety trades retreat a little, and I think ultimately that'll create another buying opportunity. So any pullback in Transurban back down to around $10.50, I'd take that as an opportunity to jump back into Transurban. Telstra, so delivered about 3% underlying earnings growth on a 6.5% dividend yield, fully franked. The stock should find support here. I think there's just some concerns in the market around continued deterioration in the fixed line income for Telstra, further capital expenditure needed in their push into the Philippines, and therefore Telstra's probably likely to just trade sideways. So somewhere around sort of 525 to 550 is probably the new consolidation range for Telstra. Westpac pushing higher again. If we sort of bring this back to the view on the index, can the index trade up to 5,500 in that environment? It puts Westpac up at around $34. I think somewhere maybe around $33 to $34 it consolidates and moves sideways. And at those levels, we want to be looking at setting the call strikes to drive the extra income, collect the upcoming May dividend. Wesfarmers, so disappointed a little when you consider that the company had been growing earnings somewhere around 8%, and the recent results only delivered earnings around 2%. The stock does pay a 5.5% dividend yield. It appears that that's pretty defensive, with Coles and Bunnings still delivering some growth. A lot of that weakness came through from the resource division, but fair value for Wesfarmers is between this $40 to $45 range, and we've been pretty aggressive with selling covered calls over it to drive the extra income, but that's a cornerstone investment in portfolios. As is Westfield. This is probably one of our preferred international property exposures, but again, it is very expensive. It's compressing down to less than a 4% dividend yield. Underlying earnings growth maybe somewhere around 5%. So we are happy to own it, but you definitely need to be going out and selling covered calls, trying to collect the next round of dividends in August and trying to get some call premium to compound that return up to around 10% per annum. Woolworths, so we're seeing the appointment of a new CEO that came from the internal ranks. The market seems to receive him quite well, but the story here is that there's still some uncertainty around what does the disposal of the Masters hardware assets look like. Ultimately, how is the put option where they owe money to Lowe's in America resolved, and what underlying growth does it leave Woolworths in the food and liquor business? Now, as I've alluded to in previous recordings, I think with the Masters issue resolved, the food and liquor business, as we once knew it, probably fair valuation for it's up at around $26, puts it on about a 4% dividend yield, and that assumes about 5% underlying earnings growth. But I don't think we get there until we see more clarity on the cleanup of the Masters fiasco. Woodside Petroleum, so in line with the oil price moving higher, it's interesting that Woodside's lagged, say, Origin and Santos and Oil Search. And the only reason I can really put that down to is whether the market's viewing Woodside as the acquirer and maybe the others as potential takeover targets, and more money's flowing into those smaller businesses that are likely to be taken over. But putting that aside, I think Woodside probably has the opportunity to trade back up to around $30. Don't see it doing too much more than that. And there we are back at the index. So the general message for portfolios is, look, it needs to be recognised that we're in a counter trend bounce. It's very hard to know when counter trend bounces roll over. When they do, it can happen quite quickly. The underlying problems in the market haven't been resolved, namely the issues in the European banking sector and slower global growth. ECB meet on the 10th of March, and we'll look for commentary out of Mario Draghi. At this stage, we're probably just likely to get more rhetoric, which is ECB is willing to do whatever it takes. But the markets probably will soon get impatient with not having the European banking issues and the non-performing loans addressed. And I think in that environment, what we get is at best the market being patient and a consolidation. But if we were to get sort of into probably the mid half of this year without a resolution to improving global growth, and the prospect of the US or the Federal Reserve having to retreat further on the prospect of them raising rates, I think a lot of uncertainty still would remain unanswered. So my general consensus on the market is 5,500 is achievable. If we get there, I think it's a long consolidation, and that may ultimately end up leading to an area that it's worth de-risking portfolios a little bit. It's far too early to form that view. Right at the moment, it's about sort of riding this recovery up and trying to protect the portfolio as quickly as possible when we start to see selling re-emerge in this counter trend bounce. Thank you for listening in. I look forward to speaking again next month, I should say.